We are live, sir.
Yes. Good afternoon, friends. Kindly recall the discussion we are making on financial instruments. So let me briefly recall the one that we had in the last class. Financial would mean monetary. Remember the points that we were discussing. I will take you to those books. Sorry. So in NDAS 21, we used to have a balance sheet item into two as monetary and non-monetary. Assets and liabilities expected to be settled at the value stated in the balance sheet. Examples are cash accounts, receivable accounts, payable, debenture, interest outstanding, etc., including bank overdraft. Interest outstanding, bank overdrafts. Such of those stuffs where you find the values at which they are stated or the values at which they are expected to be realized or paid, other than these monetary or non-monetary in nature. So then from Ind AS 20 AS 21 to financial instruments, when you take up where financial instruments in which you have financial assets and liabilities. So financial assets and liabilities are similar to that of your monetary assets and liabilities, plus or minus some changes that we are going to make. So whatever examples that we have chosen for monetary, they are taken up cash, accounts receivable, accounts payable, debenture, interest outstanding, bank overdraft. Then investment in other companies, debt and equity securities, right? Then we do have other than financial inventory, PPE, equity, share capital, investment in property, prepaid expenses, provision for warranty, tax liability, DTA, refund due, etc. So when it comes for tax liability, is it not the sums at which they are stated as payable shall be taken up as similar to that of creditors and all that? The answer will be in the negative. No, you can't do that. The reason is that financial instruments will cover only those items which have come on a contractual basis. So that one which is considered to be mandatory, like tax payment, where the government of any country will not be entering into an agreement with the citizen that they got to pay tax. So it is becoming statutory liability. It has become a mandatory things. So such of those mandatory items are not covered under this financial instruments. So the moment when we use the term as instrument, we should understand that it should be arising out of a contract. So whereas it is not a contractual obligation to the government, it is becoming a statutory obligation. So when you look into financial asset and financial liability, in the case of financial asset, it should be a cash. It should be a cash or close that. So it should be cash, investment in other companies, debt and equity, right to collect cash or financial assets. Then exchange of financial asset or financial liability, which would result in potentially a favorable position. Usage of own equity instrument, we have not discussed about that. Financial liabilities, where you do not have a parallel discussion for cash and investment in other companies, debt and equity. And obligation to pay cash or financial asset. Then exchange of financial asset or liability, which would result in potentially an unfavorable position and usage of own equity instruments. Right. So financial assets are classified as amortized at amortized cost, fair value through OCI and fair value through profit and loss account. So what is that we have in the case of amortized cost? It should satisfy two conditions. Number one, business model test and SPPA test. These two tests we should have passed. Then fair value through other comprehensive income. In the case of business model test, hold till maturity concept should be there. So if I hold a particular instrument, I should hold it till maturity. This is the perception we carry, but that perception need not necessarily be as associated with the instrument. It is for a purpose also. But generally, till maturity would mean instrument only we normally there is gather. Hold it till maturity is okay. or if opportunity is there to sell, it can be done. What do you mean with that? You need not hold it till maturity. You can sell it even before the maturity also. So if you have double mind, then it is fair value through other comprehensive income. No conditions are expected to be associated for fair value through profit and loss account. So since it is a fast track, I'm not going into greater detail, but at the same time, I'm just briefly recalling. SPPI is cash flow takes care of time value of money. Interest rate is pegged on a variable base, that is an inflation index or inflation base, not other than the inflation index. Even zero rate is also acceptable. It can be fixed, it can be floating. So all that stuff we do have. Now let us just proceed. What is amortized cost? Amortized cost is nothing but where no adjustment is made for the changes in fair value of financial assets. So always remember debtors account in your mind when you are saying that it is that amortized cost to balance brought down, to sales, to interest for delayed payment, then on the credit side by sales return, by bad debts, within brackets impairment loss, then comes by discount, yearly payment, and by cash, and lastly by balance carried down. So initially, financial assets shall be booked at fair value, whether it is classified under OCI or P&L account or amortized cost. Initially, everything will be taken up at fair value. Subsequently, changes in financial value, that is fair value, will not be affecting the financial asset. So fair value through other comprehensive income and through profit and loss account, where changes in fair value shall be captured. So in the case of financial liabilities, amortized cost is a residuary category. Fair value through profit and loss account is by default we take into consideration. Then let us just know about own equity we were talking about. So own equity instrument to be taken up under financial asset as well as for liability. When you have this own equity instrument, so we will have how own equity instruments could be taken up as equity or debt. So whenever we use our own equity to settle any liability, whether we should take it up as equity or liability, that is going to be a very big question in many of those cases that we will be coming across. So to know about us whether it is an equity or debt, we have one particular F to F test. F to F test, past conditions, they are equity. F to F test failed, it will be taken up as debt. So how come? See, whenever a consideration is considered to be fixed and where the number of equity shares or instruments when they are fixed. So we can have so if the consideration that is fixed and the number of instruments is also fixed would mean then the result is going to be equity. If the consideration is fixed and the number of instrument is variable, then it's going to be debt. If this is variable and if this is fixed, then also it is debt. If both are variable, then also it is debt. So there is only one combination in which the issuance of own equity instrument will be taken up as equity. In all other cases, it will be taken up as debt. So I will give you one or two examples, then you can easily understand as how issuance of own equity need not necessarily be an equity instrument in the transactions that we take it up. Gopala, இது எண்டத்தில் இருக்கு பாரு. FTF test எதில் வருதுன்னு பாரு. So now let us just take up a scenario. What sort of scenario that we will take up? So example number 1, purchase consideration is rupees 2,40,000 and settled by issuing 12,000 equity shares. So here F2F test passed. How come? Where consideration is fixed and the number of shares also fixed, predetermined, F2F test passed, and therefore the instrument will be taken up as equity. Example 2, purchase consideration is rupees 2,40,000 and settlement is based on market price per share on the date of issue of shares. So purchase consideration is fixed, but in how many number of shares that 240,000 will be settled is not clear. So settlement is based on market price per share on the date of issue of shares. Settlement is based on market price on the date of settlement. So assume that market price per share on the date is rupees 50. Then F2F test failed. F2F test failed. Then number of equity shares shall be 240,000 divided by 50. So how much it comes to 240,000 divided by 50? So it comes to 4,800 shares. Correct. So next one is example number 3. Purchase consideration is based on net assets of the vendor company, but settlement will take place for 12,000 shares. So here F2F test failed. How come? How come F2F test is failed? So purchase consideration is not predetermined. It all depends on the net assets of the vendor company. That is at fair value. That we do not know. That is not predetermined. That is all variable. But how many number of shares through which they will settle, they have given, and they are predetermined. So therefore F2F test failed. And therefore issuance of equity shares will be taken up as debt. Same in this case also, it will be taken up as debt. Even though the form in which settlement is taking place is going to be even though the form in which the settlement is taking place will be equity shares, it will not be taken as equity. 4. So here both will be variable. So purchase consideration is based on net assets and shares are issued. Shares are issued based on market price per share on the date of issue of shares. Here also F2F test failed. Same reason I will be quoting. So there can be a question in the main examination that you would be getting. Now let us just see. There are few illustrations that we have it in our institute material that we can use it. So now let me just take up. It is equity and liabilities. Under that, it comes under illustration number 15, 16, somewhere in that region. So I wanted to showcase this item because these are the places where students would find it difficult to take up. I would have just updated in my notes in a different order. So here I would consider this way: consideration of financial instrument when it is fixed, number of own equity instrument to be issued, fixed and variable, financial liability. Own equity instruments are being used as currency to settle obligation for a fixed sum. So it will be taken up as debt. Fixed and fixed equity issuer does not have any obligation to pay cash and holder is not exposed to any variability. Therefore, item number 2 alone is equity and the rest of which are taken up as financial liability. Correct? This is what they say. The principal at serial number 2 in the table above is also fixed FRF test. The fixed amount of cash or the fixed or other financial asset for fixed number of equity shares. You said in other places also you have. One moment. So now let us just take up on to illustration number 14. CBA issues convertible debentures of RQP Limited for a subscription amount of 100 crores. Those debentures are convertible after 5 years into equity shares of CBA Limited using predetermined formula. So 100 crores into 1 plus 10% to the power 5. This is the future value divided by fair value on the date of conversion. So your numerator is fixed, but the denominator is dependent on that particular point of time, that is the date of conversion, which is not where you do not know the number. It becomes automatically a variable number only. So therefore, F2F test is failed. Such a contract is a financial liability of the entity, even though the entity can settle it by delivering its own equity instrument. It is not an equity instrument because the entity uses a variable number of its own equity instruments as a means to settle the contract. The underlying thought behind the conclusion is that the entity is using its own equity instrument as currency. So the original idea is not to see, we need to understand, just because equity shares are issued, it is not an equity instrument. You are using equity instrument just in place of, in lieu of cash. So therefore, the character of liability will continue to be there even though equity shares are issued. So therefore, you need to be very careful. Just because equity shares are issued, you cannot consider that as equity capital, that is equity instrument. Conversion into a fixed number of equity instrument. So DF Limited issues convertible debentures to JL Limited for a subscription amount of 100 crores. Those debentures are convertible after 5 years into 15 crores equity shares of rupees 10 each. So what are the things that we are expected to take it up? So we know the target number is a fixed amount. Those debentures are convertible after 5 years into 15 crore equity shares. So you need to tell us whether F to F test is passed or failed. So the contract is an equity instrument. How? I know what is the consideration I got to settle. 100 crores. You know how many number of shares that you got to issue for that. 15 crores. That also predetermined. So when both are fixed, then we need to consider the instrument that they've issued is equity, not a debt instrument. This contract is an equity instrument because changes in the fair value of equity shares arising from market related factors do not affect the amount of cash or other financial assets to be paid or received, or the number of equity instrument to be received or delivered. So this is passing F to F test. So I hope that like this you are expected to carry out. So this particular portion I felt that we have just missed out. So now let us just take up. Now this illustration number 32. In the last class I said I will take it up for today's class. Okay. So though a related problem we have already solved. Illustration number 32. Issue of borrowings with fixed rate of interest. A Limited has made a borrowing from RBC Limited for rupees 10,000 at a fixed interest of 12% per annum. Loan processing fees were additionally paid for rupees 500 and loan is repayable is payable for half-yearly installments of 2,500 each. Details are as follows. Loan amount 10,000. Date of loan starting date 1st of April and date of loan finishing date 31st of March X3. Description of repayment. Repayment of loan starts from 30th of September X1 to be paid half-yearly. And installment amount is 2,500. Interest is 12% per annum. And interest to be charged quarterly. Upfront fees 500. How would loan be accounted for in the books of A Limited? Consider IRR at 16.60%. I was just only contesting this, that they don't have to give this 16.6%. See, in a textbook they can provide, but under examination condition they need not provide. So let us just know about what exactly had happened. We are revisiting. So illustration number 32. So point number 1, the loan amount is for rupees 10,000. Transaction cost rupees 500. So understand that A Limited is expected to show report borrowings at rupees 9,500. We are not supposed to take up at 10,000 and transfer transaction cost to profit and loss account, because you have to net it off and show it at 9,500. Okay. Now, so we understand that we are having half-yearly payment of 2,500. The principal is paid at the end of each half year and interest is charged quarterly. So, though you report 9,500, the loan amount outstanding is 10,000 for bank purposes. You reported 10,000, that is, you reported 9,500, but banker will take up only at 10,000. the sum that you have borrowed. The rate of interest is 12%. Now let us take the calculator and work out on 10,000, 12% for 3 months period. So interest for this period is 300. Correct. That is quarter number 1 cash flow is 300. Next one is for this period also 60 maybe. Promo fill up in class. So here it is going to be for this particular quarter number 1, it is like that. For quarter number 2, since this amount is paid, we will have another 300 for this period, and 2500 is getting paid, and it is 2800. Quarter 3, now the amount outstanding will be 7500. 7500 into 0.03. 225 for quarter number 4. $225 plus 2500. It will be 2725. Quarter number 5, quarter number 6. So here the sum outstanding is going to be 5,000, and upon that it is going to be 115 in both cases. 650. And amount outstanding is going to be 2500, and it will be 75 in these two cases. Quarter number 7 and quarter number 8. Quarter number 7 and quarter number 8 being 75 and 2575. So when the cash flows are 300 and 2800 and 225, 2725, 150, 2650, 75 and 2575. So look into the cash flow statement: 300, 2800, 225, 2725, 155, 2650, 75, 2575. When you operate this through your IRR formula, what you get is 4.16 for per quarter. 4.16% per quarter. Per quarter. Sorry. Per quarter. Naturally, it is going to be per annum. 16.6% they have arrived at. Imagine that they have not provided you any sort of help under examination conditions. So let me just tell you as how you got to crack it. So you can discount it at, see, when you know that it is 12% per annum, that you are doing it. So quite naturally, with 9,500 as the borrowing amount, you should only be understanding effective rate of interest should be more than 12%. Marginally, but since the frequency of the interest computation is kept at on quarterly basis. So you can say it cannot be a little over 12%. So little over the stated percentage, you would get it provided the interest. It is not so, it will be in a different fashion. Okay. So have that in your mind. Therefore, you can start at randomly at say 16%, because after 12, when you take up the next round number could be 16%. So you can take it up PV factor at 14% and operate, so that you can interpolate and you can get it. So this is the point which I want to tell you. See, in the last class, when we did this, I have assumed a different thing, and that was the reason as why we could not get that 4.16% per quarter, and 16.6% per annum. It's okay. So that is a point I thought I will discuss. So all the worked out illustration and book back questions and illustrations are so important for your examination, where you cannot skip that. Right. Now, with this, illustration number 32 is getting over. So now let us just have a look at what they've just mentioned there. 16.6%. So it is all about how would the loan be accounted in the books of EA Limited. So they have not just done beyond this particular point of time, 16.6%, and they have closed it. So it was just kept incomplete only, because what is the effective rate of interest is what we are expected to do this. So now let me just carry out that as how we will consider the entire thing. See, the solution becomes incomplete actually. See, in institute material, it is an incomplete solution. How come? They got effective rate of interest only that. Yeah. So we are expected to compute it in a different way. So though in the same Excel sheet they have just done, so I wanted to do it as a separate solution. So quarter 1, 2, 3, 4, 5, 6, 7, 8. So opening outstanding. Opening outstanding, how much is that? 9,500. Interest expenditure. Here is a place where 16.6%, because they've used all this. When we are doing it independently, I would just hold it at 16.63%. 16.63%. This multiplied by this percentage divided by 4, comma 0. So cash flow is, this is the cash flow. Then closing outstanding. Opening plus interest minus cash flow. 399. Say, as far as the banker is concerned, whatever computation of interest he makes and whatever installment that he takes, that is becoming the cash flow, regardless of how the same is treated in the books of the borrower. 7194. Interest expenditure 225, 7268. 302 2725 4845. So now you see you are having 1 rupee difference. That is on account of approximation. That is the reason as why I have told you. If you do it at 16.60 16.60 percentage, it would not have just come at all. So now let us just take up this. Let me make this as 102. I'm sorry, 104. Then it would have come to 0. So interest and the cash flow, the interest expenditure has got to be taken up in this fashion only. Now let us just see as how the same is taken up. 389, 395. There is a difference between now 6 rupees. 401, 399, 2 rupees difference. Why? It is on account of we taking it up at 16.63 percentage, whereas they have given it at 16.60 percentage. So imagine that if it is 16.60 percentage, then this number would have been closer to what they have stated. 389, 394. So I just don't want to change it. What is right, I'm just taking it up. Okay. So that's the way we are completing illustration number 32. And that is the way that problem is getting over. So it is better that you prepare 2 different tables. And in our institute study material, for want of space and to create more accuracy in the computation, they have used days calculation and all that, whereas we have just done on monthly calculation. Say, how come a student would know that you have to do it in one problem with number of days in all other problems on monthly or quarterly basis? So I don't think so. It would be a great difference that you have in the final presentation. So the answer is this, and this is the way you're going to proceed. You can just try any number of problems with keeping different numbers for your computational conveniences. So now let us just take up that classification area is getting over. So now let us just proceed on to comprehensive illustration area. So yesterday we have just done there is book back. I mean the book back portion only we are expected to do. Under that, book back first part of the question I think we have just completed. Right, we will complete that. Illustration, that is exercise number 2. First one I think we have just completed. Now we will take up on to question number 2. Wheel Company Limited has a policy of providing subsidized loan to its employees for the purpose of buying or building houses. Mr. X, whose executive assistant to the CEO of Wheel Company Limited, took a loan from the company on the following terms. Principal amount 1 million, interest rate 4% for the first 400,000, 7% for the next 600,000. Start date 1st of January 20x1. Tenure 5 years. Prepayment full or partial prepayment at the option of the employee. The principal amount of loan shall be recovered in 5 equal annual installments and will be first applied to 7% bearing principal. The accrued interest shall be paid on an annual basis. Mr. X must remain in service till the term of the loan ends. Market rate on comparable loan available to Mr. X is 12%. So, is it question or answer? Now, following table shows the contractually expected cash flow from the loan given to X. So, date they have mentioned first one, the principal repayment and interest that is getting adjusted firstly with 7% and then with 4% and principal outstanding. The schedule of repayment is what they have just given. Mr. Yes prepays 2 lakhs on 31st of December, reducing the outstanding balance as at the date to 4 lakhs. Following table shows the actual cash flows from the loan given to Mr. X considering the prepayment on 31st of December 20X2. So when you have this, there is a change happening and record the instead of getting repaid by 1st December because of one prepayment that you have made in advance, your repayment is advanced by 1 year. Record the journal entries in the books of V Limited considering the requirement of Ind AS 109. See, now let us basically understand whenever you have one particular rate stated, one particular rate at which interest is being taken up, that is where wheel company subsidized loan when they are giving. I told you in the last class that the intention of the intention of the loan, the intention of giving the loan is to retain the employees for some number of years. Correct? See, all of a sudden, video gone off. So I'm just seeing the camera. So all of a sudden, it is not showing that it is on. That is the reason as why you made a change. So we understand that any company, for that matter, when they provide a loan at a concessional rate, it is for love and affection, we understand, but thing is that the inner intention is to retain the employee. See, sir. The market rate of a comparable loan available is 12%. What he could get elsewhere at 12%, now employer is providing at 4% and 7%. So we are not expected to report all this at the stated figures. We are expected to find out the reality and proceed. And they have also mentioned the principal shall be recovered in 5 equal annual installment. Here they have mentioned it very clearly. Principal amount is recovered in 5 equal installment and will firstly be applied with 7% interest bearing. So without looking into the next page, I would like to run through, because as you have it in Excel, uh, those data where it will be very easy for us to operate for understanding and for explanation purposes. So in 5 years, the loan amount will be knocked off because 5 equal annual installments, it will be knocked off. So opening outstanding interest at the rate of 4% and at the rate of 7%. There are two loans that you have. Principal repayment. Then total cash outflow. Then closing outstanding. So opening outstanding is 10 lakhs. Now you have this particular thing charge for the first 4 lakhs 4% and the remaining at this. So here 4 lakhs multiplied by 4%. Here it is going to be 10 lakhs minus 4 lakhs into this. Principal payment is in 5 installment they are knocking it off. So 2 lakhs each. That is what we have to understand, no? 10 lakhs divided by 5. So total cash outflow would be 16,000 plus 42,000 plus principal payment. We are expected to find out as how closing outstanding has got to be taken up. Plus opening one moment. Plus minus 250. 8 lakhs amount outstanding. See, now this will continue to be there. Here 2 lakhs gone. How we have just done is that we can apply once again the percentage has got to be fixed. How come? On 10 lakhs we have applied this figure. 2 lakhs gone. So when this was applied for on 6 lakhs, we should be done for 4 lakhs. We can work out this way also. In this 8 lakhs, that 4 lakhs you were having it at a different rate, on which when you apply this coming to 28,000. Principal repayment is going to be this. Cash outflow is this. And this is going to be 6 lakhs. So you can even develop one column 7% loan outstanding will be 6 lakhs minus this. This is going to be 6 lakhs minus this minus this. Correct. 4% loan outstanding. That will continue to be at 4 lakhs. Now next is going to be 6 lakhs 16,000, and how much it will be? So that will get reduced because 2 times you have repaid that. So here, how much is the sum outstanding? This is going to be 0. How come? 6 lakhs you have taken as loan minus the first installment minus the second installment minus the third installment. So the entire outstanding is belonging to 4% category. This is going to be 0. You will not have any outstanding under 7% category. 2 lakhs, and this is going to be 0. This is going to be this minus this. Correct. So in this particular case, it is 8,000 only. Correct? Zero. This is the way the loan will get closed. So this is what they have given in this particular table. So how this, say, firstly, I was just thinking as whether it is a solution. So only then we understand that this table is given as an additional document that is given to the borrower along with the sanction letter saying that this is the scheme of repayment that you got to make through the term. Mr. Yes prepays 2 lakhs on 31st of December, reducing the outstanding principal as on the date to 4 lakhs. He prepays. So when he prepays, which loan will first get knocked off? So we have this particular matter that they have mentioned. The principal amount of the loan shall be recovered in 5 equal installments and will first be applied against 7% interest bearing principal. So it's quite natural that any borrower, when he prepays, he would like to put the burden less. So therefore, the costlier loan he would like to firstly adjust with. So 7% is what you find he would like to adjust. That is why Mr. Yes prepays 2 lakhs on 31st of December, reducing the outstanding principal as on the date to 4 lakhs. See, whenever there is a change in the schedule, how the same will get adjusted. So here is the one with a changed table that they have given. So I would like to run through once again with a change in the repayment. So I would like to copy this and put it here. So this is ideally happening here, practically happening or actually happening. Actually happening. So at what point of time they are bringing out this prepayment? Prepayment at this point of time is 4 lakhs. That is, maybe the employer would have got some capital gains elsewhere and wanted to utilize that space. So imagine here it is 4 lakhs. So don't look into the other items. I will even cancel them out. So 2 lakhs additionally that he is repaying. So what was outstanding initially for 4 lakhs, with this additional payment of 2 lakhs, it will come to 0 position only. Now what will be the sum outstanding then? Instead of 6 lakhs here, it is going to be 4 lakhs. 16,000, this is going to be 0. Why 0? Here the prepaid. Principal repayment is only 2 lakhs at this moment. Cash outflow 216. Closing outstanding is going to be 2 lakhs. 7% loan outstanding is going to be 0. And this will be 2 lakhs balancing figure. Instead of getting the loan outstanding till 5th year, now it will get over 1 year early. So this is going to be 8,000. This is going to be 0. This is going to be 2 lakhs. And this is going to be 0. 0 and 0. So you can understand that instead of running it for 5 years, you find that it is going to run for 4 years. So first and foremost thing is that we should firstly understand the question itself. Now, having taken up more time for understanding the question, the solution for which I would like to utilize the solution given in the institute material directly. So that is what, see, at one point we have got to, because if you look into the solution, it is going to run. See, unless the question is understood in a clear-cut manner, it becomes little challenging, and that is the reason as why I have spent more time. So all of you closely follow us how it is working out. So mark this problem as very, very important from your examination point of view. So now let me just draw it out. So let me explain it. All of you just watch out. So as per the requirement of Ind AS 109, a financial instrument is initially to be measured and recorded at its fair value. Therefore, considering the market value of interest of similar loans available to Mr. X is 12%. I do not know whether it is yes or X. I do not remember, but the employee's name is, one moment. Huh? It will keep on disturbing. So therefore, it is better that I just. So as per requirement of Ind AS 109, see that we have just seen. So you have the schedule and you have the cash flow. Correct. So when you have the cash flow and the PV terms taken up at 4 decimals in this particular case, so your present value of all that comes to 843, 878. So all of you please just understand. So when we have the total cash flow there, it becomes a little easier for us to operate this at 12%. Let me just take up PVF, and at the top we'll make it out at 12%. Round 1 divided by 1 plus 12%. So with the cash flows, that being, I would like to take up the cash flow with a color. So that it becomes easier for us to operate. Present value of cash flow. So this is what you have, 843, 878. 843, 878 is what you have total cash outflow through the term multiplied by 12% PV factor. You just get this. One moment. So it is 843, 886, right? Please understand what the employer will do in his books of accounts. I'm just taking up for discussion along with the institute study material solution. So to understand this question only, we have done all this exercise, even though the schedule of repayment were all given in the question. So understanding is very important. So the difference between the amount of loan given and 843, 886, the difference will be taken up as employees cost. employees cost. How much is that? The amount of 10 lakhs loan minus this. This is expected to be amortized over a period of 5 years. So 156, 121 is what they have stated. That comes to 156, 114 to be amortized over the 5 years period. The deemed employees cost to be amortized over the minimum period, that is until Mr. X must remain in service. The amortization schedule as what you're going to do. So this has got to be amortized. The amortized schedule is loan amount outstanding. This is the amount principal, interest at the rate of 12%, and how the scheme of journal entries that we are expected to pass, interest so much of element that you are taking up as interest income, and 31,224. How do you get this figure? So now let us just take up 156, 114 divided by 5. So where you just get this number of 31,224, we are getting it out as 31,223. Correct? Now let us just develop that scheme of journal entries, what they have indicated, so that there is a comfort zone when we are operating it. Okay. So it is question number 2, book back. When the loan was sanctioned, debit loans receivable 843,886. Debit employees cost 156,114, and credit is to be given to cash 10 lakhs. Is that right? This is the way the scheme of journal entries that we have got to pass. Two. So when they are taking up the computation of interest, debit, loans receivable, and credit, interest income. Interest income has got to be taken up at the rate of 12% on 843,886. 843,886 into 0.12. 101,266. 101,266. Then debit cash, credit loans receivable. How much is the money that they are paying? The employee is paying 258,000. Correct. Item number 4, amortization, debit, profit and loss account, credit, employees cost. How much is the figure that we have to take up? 31,223. And item number 5, we are expected to transfer this interest income to credit to P&L account. Debit interest income of 101,266. Credit profit and loss account 101,266. So I've just done at a very comfortable zone for the first year. So only when you run through the schedule with prepayment and all that, you will come to know as what sort of changes that we got to make. Gopala? So this is what we have just done for the first year. I know that this problem is going to be a little lengthier, and when changes are happening, what sort of changes that we are expected to make, all that we will be doing it now. So how we are expected to take up interest 101, 265. So we have just done that. Cash, whatever we have received and how much we are transferring to P&L account for to employees cost and on to credit of profit and loss account interest income. So we have just done that. So this is an amortization schedule, ideally speaking. I just don't want to do that right now because in the second year itself, there is going to be a change of schedule. 31 to 24 and all that. Then what is happening? In the second year, you got to pay that interest and all that is going to happen. This is for year number 1. This particular portion will be year 0. This portion is year number 1 and remaining 2 to 5 journal entries for year number 1. Correct. Now, what is going to happen in year number 2? The scheme of journal entries will be same. Now, the scheme of journal entries need to be the same. The amounts are a little different. That's it. When 843, 886 is the sum, we will develop the schedule. Opening outstanding, interest income, cash flow, closing balance. Because we need to know how much is the sum that we are expected to receive and offer credit to this. On the opening figure, apply 12%. Cash flow is going to be 258. What is the closing? Opening plus interest minus 687, 152. So here is a place the cash flow is not going to be 244, 2 lakhs. Additionally, you got to take up. So therefore, I will take up 244 plus 2 lakhs additionally, prepayment. So 82,458 is the sum that we will be taking up. 82,458. Cash is going to be 4,44,000. So employees cost that we will be taking up will be the same, 31,223. Interest income 82,458. 82,458. Year 2. Correct. 82, 458, 457. So you should always be having, besides all this, your Excel also as well as manually you got to do. Employees cost. No, see, you know that amount later. Wait. So 244 is the sum that he is going to pay. 31, 224, 31, 224, 223. Now, what is going to happen at this point of time is your schedule will not be for 5 years. The schedule will be only for 4 years. You will not be having 3 more years left, but you will have only 2 more years to live. So, in this particular case, what is the likelihood of your balance that you're going to take it up? So, if the remaining 2 more balances that you got to pay at the rate of 4% when you take it up, this is going to be 358, 673. Whereas in your books, what is the value at which you will be shown? So imagine that this figure is not adjusted. What should have been the figure? So it is 525, 610. 525, 610. You just see. So if regular payment is to be made, it is going to be this. Now it is 525, 601. The difference between the amount of prepayment and the adjustment to the loan should be considered as gain, though will be recorded as an adjustment to prepaid employees cost, which shall be amortized over the remaining tenure of life. So instead of dividing the employees cost by 3, you got to do it by 2. So this repayment, you take into consideration this much. Prepayment, you adjust for the difference and the balance amount has got to be taken up. So now let me just put it out in this fashion. All of you closely follow. This requires enormous amount of explanation. Mark it out as very, very important. 10 star you got to mark on this. Not difficult one. Coordinating under examination conditions with objective type question with so many other topics that are running. Taking it up with a straightforward mind is going to be a little challenging, and that too in the month of May, and that too in the afternoon, because you have to travel in the hot sun, right? So the temperature of your cool mind would be a challenge there. I hope that things are very clear. Now let me just run through us how you will be taking it up. Year number 3 and 4 only I will take up, right? So here the cash flows would be, so from the employee's viewpoint, outstanding is going to be only 4 lakhs. He paid the first loan, he paid the second installment, instead of 2 lakhs, 4 lakhs he paid. So therefore from his mind, only the remaining 4 lakhs will be there. Interest at the rate of 4% only he will pay. Principal 2 lakhs he will pay, and closing right. So therefore the cash flow that he has got to take up for discounting, let us just know about that. What is the amount of the cash flow? Cash flow will be this plus this. The PV factor that we are expected to take up at that point of time would be, correct, present value of cash flow. So 358, 684. This is what you find. 358, 673, 684. Just don't worry about all that difference. So this should be the new balance. New amount outstanding. So whereas old outstanding is 525, 610. Before prepayment. Before prepayment. It was 525, 610. Correct? So new amount outstanding before prepayment is this much difference. How much is the difference that you have? Difference that you have is 166,926. So your asset is getting reduced by 166,926. Right. So by year number 2 end, journal entry shall be debit cash 2 lakhs, credit loans receivable only to the extent of 166,926, and credit should be given to employees cost. Correct? 33,074. So 2 times you have written off. So 31,223 you have just written off. So if you look into employees cost schedule, year number 1, 2, what was your opening outstanding? Opening amount is 156, 114. Amortization 31,223. What is your closing balance? 156, 114 minus 31,223. It comes to 124,891. Am I right? Yes. 124,891, 31,223. It comes to 93,668. Third, 93,668, against which we are expected to adjust 33,073. Second year only, the figure is 33,073. 33,074 in fact it is. Minus 33,074. That comes to 60,594. So in year number 3 beginning, it is 60,594. Amortization should be made only for 2 years divided by 2. So it becomes 30,297. So 30,297 in year number 4, 30,297, 30,297, and it will be brought to zero position. Employees cost schedule is coming like this. So prepayment, you have just done that. The journal entry, we have passed it here itself. Then amortization schedule of interest from now on. So you are expected to arrive at a new schedule. What is a new schedule? So 358, 684 is the new item that we are expected to try. So now let me just use this space. Okay. So we would like to take up year number 3 and 4. New outstanding, interest income, this into 0.12, comma 0. Cash flow. How much is the cash flow? Cash flow is going to be this. Closing, opening plus interest income minus the cash flow. So 13 rupees difference has got to be adjusted here. How is that we will adjust this? Now we will take up this. $22,220, 22,274. Now in year number 2, we have taken up this cash 444 is what we have just taken up. Actually, I would like to make a change there. I would like to make this as 244 only. So the fifth one, you will take it up as debit cash debit cash 2 lakhs, credit loans receivable, and credit employees cost. So whatever we have done in Excel, the same I'm just repeating it here. $166,926. Employees cost 33,074. So with that, this will come to an end for year number 2. For year number 3. One, the scheme of journal entries will continue to be the same. Copy, paste. The rental income and all that, we got to do it. 43,042. Our cash flow is going to be 216. So employees cost 30,297. $43,042. 43,042. Correct. For year number 4. So here it is 22274. The figure is 208,000. 22274, 22274. So 33072 is the adjustment that we have got to do, that we have just done. Interest income for the fourth 43041. This is the one. They are compounding two more, 2-3 items together and they are working it out. So we have just done all that. So book back question number 2, employees payment where 4% rate of interest, 7% rate of interest and prepayment schedules are all over. Mark this problem as very, very important from your examination point of view. I remember that this question was asked in 1 or 2 years. Within that 1 or 2 years, they have asked this question. Mark it out as very important. See, if you are going prepared, no, it is very easy. If a person had not seen this question, even if you give them 10 hours, they will not be in a position to get the answers right. So either you will be a rich person with good marks or person will be having very poor marks. Sorry to see that. I don't want any of you to have any difficult moments. So the point is that with Excel, I could just do that. This is going to be a little challenging when you are having a manual working that you got to make. So I need to admit that there is a challenge that is associated with this particular item. Yes. Question number 2 got over. You can celebrate. The question goes to that extent. Now, I just don't want to leave any problem unattended, especially on to this particular sector. One of these problems will come in the main examination. That is the only factor that we have. And I would like to try this problem after a break. Break I want to take up a little early. So instead of 4 o'clock, I'm just doing it by 3:30, 10-15 minutes. It will take because uh, some office work as well as I got to have something and we will be meeting after 10-15 minutes. Okay. Thank you. Yes. See, it was problem number 2. That wheel company limited problem. Market order is very important. They 10 superstar. And I could explain this much better with the help of Excel, but without that Excel, when you go to do it under examination condition, it is definitely going to be time consuming, challenging. So please practice this problem faster. That is, and at the same time, accuracy should not be diluted. Okay. Solve it with speed as well as accuracy, and practice a lot. Speed, accuracy, and practice. SAP. So now let us just take up on to similar looking problem. Wheel company borrowed 5 million, sorry, 500 million from a bank on 1st of January X1. The original terms, interest rate 12%, 11%, repayment of principal in 5 equal installment, payment of interest annually on accrual basis, upfront fees 5.87 million, effective rate of interest on loan 11.5. On 31st of December, X2 Wheel Company approached the bank citing liquidity issues and meeting the cash flow requirement for immediate installments and renegotiated the terms with banks as follows. Interest rate shall be taken up at 15%, repayment of outstanding principal in 10 equal installments. Starting 31st of December, X3, payment of interest on annual basis, record the journal entries in the books of Wheel Company till 31st of December X3 after giving effect of the changes in the terms of the loan on 31st of December X2. See, problem number 2, where Wheel Company had extended the loan to employees at concessional rate and you had prepayment where the term got truncated from 5 years to 4 years, and changes that we have taken it up and truncated the total term from 5 to 4 years, and we have completed the entire work. So in question number 5, it is on the same lines. See, in this particular case, the term is getting extended from 5 years to 9 years. I'll tell you how. Question number 3, book back. See, always good to have a time scale drawn clearly. First of January, first year, second year, third year, fourth year, and fifth year. So this period, no problem at all. So first payment got over, successful. By this point of time, 31st of December X2, failed to pay. From here, the term got extended to 10 years. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. Right. See, originally the rates of interest was taken it up at 11 percentage, stated. Now stated rate is 14 percentage. So the total term 5 years, now it is 12 years. And 100 million per annum. So outstanding principal, 10 equal installments. 10 installments. Definitely we require the schedule to be prepared very well, and Excel will be of great help to us. Okay. Now we will take it up. Book back third. When the upfront fee is this, the effective rate is a little above 11 percentage. So I would consider that 11.5 percentage what they given is not to be given at all. So even when it is not given, how do we approach the question? Original scenario. Through Excel, it is not going to take much time. So where I am equipping yourself for the worst scenario. So please be careful. 5 minutes extra in the class is not going to cost you anything. But I want the comfort level that you're going to enjoy under examination condition is the highest. So please just watch out. Opening, interest, cash flow, and closing. $5,000 lakhs or 500 million. Because I got settled only with a big number. No, this is million, so 5 million. Stated interest rate is 11 percentage. 500 million. Cash flow. How much is the cash flow? Divided by 5. I mean, I will put it this way, principal, cash flow, closing. Okay. Say now, for effective rate of interest that we are expected to carry out. Here, 0, 1, 2, 3, 4, and 5. Cash flow. So remember that this 5.870096 is also in million, minus 5.870096. 5.870096. This I wanted to put it in the negative sign. I wanted to position the cash flows here and arrive at IRR. I'm not cross verifying, so I wanted you people to know about even in a scenario where you are in a position to crack it. So 11.50%. That is the one that they given. Say, wanted to tell you that as how IRR will normally be computed. When you are provided with this information, we need to know that when it is little less than what you have initially taken, so naturally the rate is slightly to be greater than that. So if you have to do certain things in the classroom where you save some time for examination purposes, so go prepared like that. So I don't ever think that we are wasting time in the class. It is all investing. So I would like to do this exercise in this fashion. So I would like to try at 12%. Because at 11% it is going to be exactly 500. I will show you that. Will demonstrate to you discounted cash flow. The sum of that is coming to 488.38. When you book this at 11%, it will be exactly 500. I know that. So when it is at 12%, it is 488.38. Yeah, under examination condition, how you got to crack, that is the one that I am trying to help you out. So effective interest rate is equal to 11 plus, what is the number that you have? 488.38, whereas you expect 494.13. 490, or firstly, I would like to identify the rates. At 11% and at 12%. Under 11% it is 500. Under 12% it is 488.38. But we require a number which is 494.13. What is that percentage? Effective interest rate is equal to 11 plus 500 minus 494.13, the whole divided by 500 minus 488.38 into 12 minus 11. Effective interest rate is equal to 11 plus 5.87 divided by 11.62 into 1. 5.87 divided by 11.62. So exactly it is 11.51%, in fact. That is more accurate. This is the way you can crack it. So do not expect this superfluous information, you can crack it. Are you understanding? Shall we proceed? So now, original scenario as how you are getting 11.5, for which I am giving you a comfort zone. So don't get the impression that we are wasting time. No, 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 never. It is not about wasting time, it is investing time. Original scenario. What is the entry that we are expected to pass? Year number 0. Debit cash. 500 million. Credit. Loans payable. Loans payable 494.13. I'm sorry. 494.13 and debit what? So firstly we will now let's just go through the solution. We'll go according to what institute is providing, we will support that. Bank to take loan, less recognition cost. $494.13. There is no amortization cost that you have, like what you had in the year beginning, that is in the last problem. So we will run through at 11.50%. Now let us just take up. That cash flow is 155 that you have. Loan repayment and interest expenses 56, all that we will be taking up. At effective interest rate of 11.50%. Opening outstanding, interest expenditure, cash flow, closing outstanding. $500 minus 5.870096. Am I right? 5.870096. Interest expenditure. On to this, please apply 0.115, comma 0. Or we can go up to 2 decimals. Would mean we can just do that. 56.82. Cash flow is going to be this number. Closing is going to be opening plus interest expenditure minus the cash flow. So you can understand interest expenditure is going to be 56.82. So opening, interest expenditure, cash flow, and this. Next one. So here is the place where it is 0. And what it should have been? It should be this much. Whereas when it is 0, so it is happening like this. Because they have defaulted the payment for the second year. First year, there is no problem at all. So interest expenditure, we have booked 45.32. So because of rounding it off, there could always be a difference that we would be getting. So now you just find the original schedule on which what they have paid. Let us just know about what exactly was the arrangement that they have made. So let us just go through that. Payment of interest on annual basis. Meeting the cash flow immediate requirement, renegotiated the terms. So they paid the interest. So it is only the principal they could not pay. They have paid 44. So there is a interest expenditure to that extent. And we have repaid, and there is going to be a jump in the amount by a small figure. Okay. So 45.5. Correct? Credit is to be given to bank for 44. The difference is going to increase the loan amount. Correct? This is what it had happened. So interest paid, but not principal. See, now this is the place where you got to look at what sort of changes that we are expected to make from here, 10 years schedule, and how the character of the loan is getting changed, and because of that, as how outstanding is going up or coming down, and how the loss has got to be amortized. Let us just see. Upon receiving the new terms, will company recomputed the carrying value of the loan by discounting the new cash flow with the original effective interest rate. What is that? Original interest rate, effective interest rate, and comparing the same with the current carrying value of the loan. As per the requirement of 109, any change of more than 10% of shall be considered as a substantial modification. Remember, in the case of lease also, I was just telling about the same, resulting in a fresh accounting for the new loan. So this is what you consider as a very, very important item. So at this point of time, the principal cash flow is going to be 400. How come? So you paid only one installment. So therefore, there is no requirement for us to check up with any other factor. It is going to be 400 million and 10 installments, and interest to be taken up at 15%, and the discount factor is to be the same at where is that interest rate? And at original rate, that was, how much was that? 12% or 11%? 11.05. 11.5. So at that, when you are taking it up for the purpose of evaluation, what is happening is that the loan amount is jumping from the current closing amount of 397 to a much greater figure, and the difference when you take it up, this comes to 13.59%, which is greater than the 10% threshold that you have it in Ind AS 109. Calculation done on full decimal, though in that table discount factor is limited to 4 decimal. That is the reason as why you have a difference that we are having between institute and our 4 decimal approximation. Considering if more than 10% change in PV of cash flows compared to the carrying value of the loan, the existing loan shall be considered to have extinguished and a new loan shall be accounted as a separate liability. Accounting entries shall be. So the old amount shall be debited and a new loan amount is credited, and the difference shall be taken up as a loss, which has got to be not amortized but fully to be written off. And then the schedule is undergoing those changes. Is that right? So now let us just make that computation. So this problem is somewhat easier in terms like where you are expected to answer to the question when there is a change in the schedule. That's it. Now what is happening is this. Now interest paid and not to the principal. So here is a place we need to redraft the liability, under new terms of the loan agreement discounted at original effective interest rate, that is 11.50%. So year 1 to up to 10 years. Opening outstanding, interest expenditure, cash flow, closing, outstanding. This is going to be 400 million. This is to be multiplied by 15%. Cash flow is going to be 400 divided by 10 plus this. Correct. Now PV factor present value of cash flow. So this will be the new liability. Old liability increase in liability percentage of Percentage of change. $54.04 divided by 397.48. So 13.6 percentage change, which is more than this change is more than 10 percentage. Hence, it is not modification, but extinguishment. That is, existing liability will be cancelled and a new liability is assumed. The difference will be taken as loss to be written off immediately. No amortization is allowed. No amortization is allowed. Is that clear? So in year number 1, debit interest expense, $56.82. Credit loan payable, 56.82. Debit loans payable, 155. Credit cash, 155. 3. Debit P&L, credit interest expenses, 56.82. 56.82. Year number 2, debit interest expenses, 45.57. 53, sorry. Credit loans payable, 45.53. 2. Debit loans payable. Say they paid only the interest, 45.53. Credit cash, 45.53. So principal defaulted. Outstanding loans payable will be 397.48. Refer Excel. Correct. Then new loan done. Debit loans payable 397.48. Credit, this is old. Loans payable new. What is the new loans payable that they have assumed? 451.52. Debit profit and loss account, loss. 451.52 minus 397.48. So this is what you just find. Not this. $397 is correct. Loan for them is, see, that is for the purpose of computation that we have done, because your loan amount is outstanding, correct only. See that 451.52 is for checking for modification or extinguishment. So because you started only with 400 lakhs outstanding, correct. So debit is going to be 2.52, 2.51. That is rounding off will always be there. Then this is by year number 2. Year number 3, so where you are expected to pay that first installment, debit, interest expense, 60, credit loan payable, 60, to loans, debit loans payable, 100, credit cash, 100. How come? 60 plus 40. 60 is interest, 40 is principal. That is what they given in single journal entry. Okay. And 3, debit P&L, credit interest expense, 60, 60. That's the way we have just completed this. Question number 3 is over. Now let us take up question number 4. K Limited issued 5,06,000 convertible debentures at the rate of 10 each on 1st of April X1. The debentures are due for redemption on 31st of March X5 at a premium of 10%. Convertible into equity shares to the extent of 50% and the balance to be settled in cash to the debenture holders. The interest rate on equivalent debentures without conversion rights was 10%. You are required to separate the debt and equity components at the time of issue and show the accounting entries in the books, in the company's books at initial recognition. The following present values of ₹1 at 6% and at 10% are provided. So they have given you the PV factors for 2 decimals for 4 years they were provided. So whenever they give you the PV factor only for that numbers as 2 numbers or 3 numbers or 4 numbers, only that you have got to use. So it is convertible debenture. So that is they are expected to see, K Limited issued 500,000 6% convertible debentures. So at a premium of 10% into equity shares to the extent of 50% and the balance to be taken up as 50% and interest rate or equivalent amount is 10% without conversion rights. So I hope that we can understand it better by using Excel. And this is running for a period of only 5 years. 50% conversion and the balance 50% is in the form of cash paid. So year number 1, 2, 3, 4, 5. So you have the opening. So 6% is the convertible amount, whereas without conversion, it would have been at 10%. So whenever you have a different rate adopted, so it will be a cost for one company and it will be a gain for the other company. So we are expected to find out the or discount at a higher rate. Okay. So lower rate is always a concession one. Higher rate is going to be the market rate. So on 5 lakhs, if you apply 6%, the coupon will work out for 30,000. So the cash flow is going to be 30,000. 6% into 5 lakhs. Here it is going to be 30,000 plus 50% is redeemable at 10% premium. So 5 lakhs into 10% into 0.5. Correct? How come? 30,000 plus 50% into 5 lakhs into 110%. So the PV factor to be taken up at 10%, two decimal factors only. So 0.68 like. So extremely sorry, it is only for 4 years. Extremely sorry. So I will make that correction. So 261,700 is the present value. Present value of debt. The total sum is for the difference is expected to be equity. Now let us just check up. Is it 100% or 50%? Let us just see. Yeah. So you just see it is present value of the debt is it that problem? 4 only. Numbers are same or different? Is that the problem? Let me just see. Okay, they have given only numbers, I think. Face value, I have to multiply 10. Extremely sorry, say once again, the inputs are a problem. Hmm? That's only I'm just checking up. So I took that 5 lakh as financial figures. Now let me just check up where 50% present value 2821. It should be right only. Hmm? I think it should be right. Okay. 3 and 4. Okay. Okay. So that's sort of silly mistake only. 2821. So 2179. Correct. So that this was noted as 4 and 5. That made that difference. Okay. 3 and 4. Okay. So a clerical error. So what exactly was the question? So when you have an equity component to that extent, we have to pass a journal entry initially for question number 4. If this question is asked, I think students will be very happy. So debit cash, the sum is 50 lakhs. So credit, debt component 2821. Credit equity element or equity component 2179. 2179. So that is the way the journal entry is passed. Okay. So we have done 4 book back. Now we will take up on to the last one. And of course, there are some problems involving this forward contract and all that in comprehensive illustration that we have not done. Now we will take it up today. So 2 classes we have spent on lease, 2 classes we are spending on financial instrument, one class for consolidation. Now let us just take business combination also we did. So very important ones we have taken up. Tomorrow being the concluding class, we will be completing all the remaining accounting standards and whatever that is left in the syllabus. On 1st of April 1961, 8% convertible loan with a nominal value of 6 lakhs of rupees was issued at par. It is redeemable on 31st of March XY also at par. Alternatively, it may be converted into equity shares on the basis of 10 new shares for each 200 rupees worth of loan. An equivalent loan without the conversion option would have carried 10% rate of interest. Interest of 48,000 have already been paid and included as a finance cost. Correct. An equivalent loan without interest of 48,000 have already been paid and included as a finance cost. Present value is 8% and 10%. Explain how will the company account for the above loan notes in the financial statement. This being the last problem, I think so. Right. So in what way this problem is different from that of the last problem? So here the conversion option is provided to them as they will be provided for 100 shares for every 200 held. So that means Again, 6 lakhs divided by 200. 100 shares are provided. And interest of 48,000 have already been paid and included as a finance cost. Let us just see as how it is to be taken. We are expected to discount all this at 10%. அதை கையில் வச்சு பண்ணிக்கோ, அப்படியே ஸ்ப்ரெட் பண்ணாத. So it is optionally convertible 1. Now let us just go through what exactly we have to take up as step number 1, 2, 3, and so on. Step number 1, there is an option to convert the loan into equity. The loan note holders do not have to accept equity shares. They could even demand repayment in the form of cash. This is optionally convertible 1. It is not compulsorily convertible 1. In India's 32 states that there is an obligation to transfer economic benefits. There should be a liability recognized. On the other hand, when there is no obligation to transfer economic benefits, a financial instrument should be recognized as equity. When you have obligation, it is liability. When you do not have obligation, it becomes an equity. In the above illustration, we have both equity and debt feature in the instrument. There is an obligation to pay cash at the rate of 8% and the redemption amount. This is a financial liability, the debt component. The equity part of the transaction is the option to convert. So it is a compound financial instrument. When you have both the qualities, it is compound. Debt element of the financial instrument so as to recognize the liability is the present value of the interest on the payable. See, this of course that we have done in the last case also. The rate at which the same has got to be discounted will be the market rate 10%. So when you take up this, though they have initially mentioned about 5 years term, I think so. Let me just check up. So when you take up this, so X2, X3, X4, X5. So you have only 4 years, correct. So I wanted to just confirm it, and that is why we have just rolled it back. You have 4 more years to go. So with 48,000 for each one of those, and in the last, we are expected to take it up just like any other loan only. So that 6 lakhs that you have seen is the principal amount that you have, principal amount that you got to pay. All of you, please just confirm that the 6 lakhs they got to pay along with the interest. So which has got to be taken up at 10% PV terms. It comes to 560, 223, again 6 lakhs, and the balance amount is to be taken up as equity. Correct. So step number 4, the amount of 48,000 that they have already paid, for that the adjustment is to be carried out. What is that we have? The next step is to recognize the interest component equivalent to the loan that would carry. Henceforth, we are expected to consider 560, 223 as the debt instrument for the purpose of computing interest component. The next step is to recognize the interest component equivalent to the loan that would carry if there was no option to cover. That being on 560, 223 is what we have to take up. Therefore, the interest should be recognized at the rate of 10%. But as on the date, 48,000 has been recognized in the profit and loss account. They have already transferred. So which is computed at the rate of 8% on 6 lakhs. And we have discounted the present value of the future interest payment and redemption using 10%. So the finance charges in the statement of profit and loss account must also be recognized at the same rate for the purpose of consistency. The additional charge to be recognized in the income statement is calculated as follows. So debt instrument at the rate of 10%, this is rounded off figure. In fact, appropriate computation is 560, 223 into 10%, whereas they have approximated that 10%, 56,000. Already they have charged 48,000 into P&L account, and the additional charge that they are expected to carry out. So now let us just know about us how the same has got to be handled separately as solution to question number 5. Solution to question number 5. See, this is a far more simpler problem, but when they ask these questions, you need to go prepared. Year number 1, 2, 3, and 4, where the cash flow is going to be 8% into 6 lakhs. The same will be for the other years also. This is going to be this plus the principal amount of 6 lakhs. The PV factor to be taken up will be 10%. Round 1 divided by 1 plus 10% fixed. So by doing that, present value of cash flow, when you take it up, 48,000 multiplied by 0.91, 0. Is this much, and equity element is going to be 6 lakhs minus this amount. Equity and total collection is the sum of these two. So the journal entry is by year 0 is expected to be debit cash, credit debt is this, and credit equity element. Correct? This is what we are expected to do. Opening outstanding. Huh? Opening outstanding is this much. Interest at the rate of 10% when you do into 10%. So the journal entry is for year number 1, debit interest expense. Debit interest expenditure 56 this much. Credit cash, they have already paid 48,000. Credit outstanding or credit debt. So 8016 is the sum that they got to pay. So with that, solution to question number 5 is getting over. Are you clear? I hope that you people are clear about credit debt. So 8016. So with that, book back question is getting over. Now we will be taking up on to problems involving options and forwards. Yes. So we have done on the other day up to problem number 2 we have just done. This problem we have done illustration number 2. Illustration number 3 I said I will take it up a little later. Now we will try this. Illustration number 3. On 1st of January 20X1, Sam Company Limited agreed to purchase USD 20,000 from JT Bank in future on 31st of December 20x1 for a rate equivalent to 68 per USD. SAM company did not pay any amount upon entering into the contract. SAM company is a limited company in India and prepares its financial statement on a quarterly basis. Following the principles of recognition and measurement as laid down in Ind AS 109, you are required to record the entries for each quarter ended till the date of actual purchases USD. For the purposes of accounting, please use the following information representing marked to market fair value of forward contracts at each reporting date as at 31st of March X1, 25,000 within brackets, as at 30th of June 20x1, 15,000 within brackets, as at 30th of September 20x1, 12,000 without brackets, and spot of USD on 31st of December 20x1, rupees 66 per USD. Right. So at this moment, let us just know about as how forward rates or forward contracts are to be accounted. Say earlier to this in years, we used to do on AS11 basis. So after the advent of financial instruments and when applicability got shifted, so we got to account as per Ind AS financial instruments. One moment. On 1st of January X1, SAM Company Limited purchased 20,000 from JT Bank in future date for a rate equivalent to 98. So we need to know, this is question number 3, illustration. So we understand the dates are you know 1/1, 31/3, 30th of June, 30th of November, and 31st of December. So when they are entering into your transaction, this is the transaction date. I mean forward contract rate, contract date. So maturity is by maturity date, 31st of December. These are the dates on which a quarterly statement that they are preparing. So they got to recognize, they have to close their obligations or the rights which are marked to market. So this may be the first quarter ending, this may be the second quarter ending, this may be the third quarter ending. So we are expected to take it up as transaction number 1, transaction number 2, transaction number 3, transaction number 4, and transaction number 5. So I've given you the time scale and the transaction that we have and how we are expected to recognize. So $20,000, we are entering into a contract and the rate is 68. So there is no, at this point of time, the date of the transaction is 1st of January. Transaction is forward contract booked. Forward contract booked would mean what is the value of this particular contract. See, on this date, when they are entering into your transaction, the fair value is expected to be 0. What is that? The item is expected to be taken up as 0. So fair value, so here I wanted to just make a note. Fair value on the spot shall always be 0. Correct? On 31st of March, first quarter ending. So a person who is entering into a contract on this date by 31st of December, that rate is going to be same. Here, by first quarter ending, for the same maturity date, the rate may be different, which may be advantageous or disadvantageous to us. In this particular case, it was disadvantageous to us, 25,000 rupees loss. We will regret to have entered into a forward contract. Correct? So here I am expected to have a comparison. I got to make it out as 68 minus 68. I have entered into a contract with 68 where the maturity value is going to be 68. So therefore 68 minus 68 is going to be 0, because for 20,000 I have booked, $20,000 I book would mean it is going to be 20,000 into 68 minus 68. I have booked a forward contract on 68, and the fair value of that particular security or that particular contract is 68. Now, all of you closely follow. 20,000 into, say, you can find people entering into a contract at various points of time for the same maturity date, isn't it? See, I have an IPL on 19th of April. Let us assume 19th of April, an IPL. For that IPL, I am expected to book for a ticket at any point of time before, say, 17th. Let us assume for the last 2 days, they are not booking any contract for that, because advance booking would mean advance date only. So on 1st of April also a person will book on 19th of April, 2nd of April also they will be booking on 19th of April. So this way the IPL tickets, let us assume, is not a fixed sum which is fluctuating. So a person on 31st of March, when he had booked a contract, that particular contract is resulting for 25,000 rupees loss. So 25,000 rupees loss would mean that would have been available in the market at 66.75. 66.75 minus 68, resulting in a loss of how much? 25,000. So what they did not provide in this problem is that the forward rate change, these changes that they have not provided, and they've given you a loss figure of 25,000. Is that clear? So that is the reason as why the journal entry part on the spot date will always be nil. Why no journal entry is passed? Because the fair value is going to be 0. So even if you are not in a position to understand, please just don't worry. On the day of entering into a forward contract, that day you do not pass journal entry, because 68 minus 68, when you bring out as a comparison, that is going to be 0. That is multiplied with 20,000 units, and it will be 0 only. So on the same maturity of 31st of December, on 31st of March, 9 months later, the same matter is available at 66.75. You would have regretted, why did I do it by 1st of January itself? I could have as well done it by 31st of March. It would have been available at 66.75. So therefore, I feel like I have lost to the extent of 25,000. So therefore, we have to book the loss. Okay. Now let us just look into what is the entry that we are expected to pass. So profit and loss account, debit, credit, derivative liability. Debit P&L account, credit, derivative liability. So I know that I have booked a loss. So therefore I am crediting a liability. Is that right? Then by 30th of June, what happens? The loss is getting reduced to 15,000. That means initial booking of loss is getting reduced. Second quarter ending, 20,000 into, I do not know the figure. I am just telling you the background. Sometimes instead of giving 25,000 rupees loss, they might even give the forward rates on these dates. Please be careful. Are you understanding? So this loss is going to be 15,000. So when this loss is going to be 15,000, when that is divided by 20,000, it is coming to 0.75. When compared to that, it is 67.25. 67.25 minus 68. This got our loss reduced. So debit derivative liability 10,000, credit profit and loss account 10,000. Just see. Correct. Then on 30th of September, third quarter ending, 20,000 into what number we do not know, but this number is going to be 12,000 favorable. So 12,000 favorable, 0.6. So 68.60, and this being 68, resulting in 12,000, and debit what? The loss, because of this, our liability got reduced to 15,000. Now it is no longer a liability. Now it is becoming an asset. Derivative liability to the extent of 15,000. Derivative asset there to the extent of 12,000. Credit is to be given to profit and loss account for 27,000. Just see. So that is the way you are expected to carry out on this particular date. Then what has happened on the last date? Maturity date. On the maturity date, what is the value at which settlement took place? So on that day, it got settled at 66. 31st of December, fourth quarter ending. 20,000 into 66 minus 68, which resulted in 2 into 20, 40,000 rupees loss, which resulted in 40,000 loss. Debit. That loss of 40,000, how you find? Our gain of 12,000 that we were making, that has got to be knocked off. So this 12,000, what we were considering it as an asset, is no longer an asset. And you are expected to make to the banker your contracted sum of 60 at the rate of 68. And for whatever money that you are receiving, you got to book it at 66. So you are expected to record the transaction at the spot rate. So that point of time, we are expected to book to cash. What is this cash? This is dollar cash. So, but I got to book. So each dollar, I got to book it at $1 equal to 66. I'm getting 20,000 $20,000 at the rate of 66. How much is that I'm getting? 20,000 into 66. 13 lakhs, 20,000 is what you are getting. Then credit cash. What is this? This $20,000 I got to pay at the rate of 68. The contracted sum 20,000 into 68. How much it comes to? 13 lakh 60,000. But I've already booked an asset, credit derivative asset. And I got a debit to profit and loss account. Debit profit and loss account. How much? 52,000. This is the way the scheme of journal entry is getting closed. Are you clear, all of you? Please always remember, either the figures that you have in this problem can be provided in terms of the exchange rate itself, or in this problem we are very fortunate that they have given you the gain or the loss. Imagine that these gains and losses were not provided, but when they have provided the dollar rates, you are expected to compute the gain or loss, and accordingly we have got to take up the case. Is that right? So mark it out as very, 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 very important. Okay. So illustration number 3 over. Yeah. Now let us just take up on to question number 5 now. So we will take up illustration number 4 a little later. So something which is very similar to 3 you are having. So therefore I am taking it up. Okay. On 1st of January, X1 SAM Company Limited entered into a return put option for US dollar 20,000 with JT Corporation to be settled in future on 31st of December X1 for a rate equivalent to 68 per USD at the option of JT Corporation. SAM Company did not receive any amount upon entering into the contract. There is premium is not mentioned there. SAM Company is a listed company in India and prepares its financial statement on a quarterly basis. So following the classification principles of recognition and measurement as laid down in Ind AS 109, you are required to record the entries for each quarter ended till the date of actual purchase of USD. For the purpose of accounting, please use the following information representing mark-to-market fair value of put option contract at each reporting date. As at 31st of March X1, 30th of June X1, and on 30th of September nil. Spot of USD on 31st of December X1 is 66 per USD. See, now let us just understand what exactly the time scale diagrams with explanations are always helpful, and we can remember those points for our examination purposes. So always remember that. This is the way I normally do even when I was a student. So we have these dates like this way. 1st of January X1, 31st of March X1, 30th of June X1, 30th of September X1, 31st of December X1. These are the dates that you have. So they have not received any amount is what they said. That means premium is not received and it is writing a put option. Right put. Strike price 68. So right put exercise price 68. So put exercised when future spot price is less than exercise price. Put not exercised when FSP is greater than or equal to X. So the fair value on this date is expected to be 0. I told you already, for any contract that you are entering into a forward contract or any derivative contract, the fair value on that transaction date is going to be 0. They have mentioned it as 25,000 rupees loss. If the holder is expected to exercise on this date, it would have cost 25,000 loss to them. This would have been 15,000 loss, reduced loss now, and this is where to be nil. And when it is 66, so quite naturally it will be exercised, and 2 will be the loss per unit. And when it is 20,000, the loss is going to be 40,000. Correct? So we are expected to pass a journal entry in the same fashion as above. This minor change only. Now let us just look into what entry that we are expected to pass. So no journal entry will be passed at that point of time. So the same journal entry what we have seen for 25,000 that we have booked here, that is what we will be passing. Debit P&L account, credit derivative liability, 25,000. Same. So here the liability got down by 10,000, and that is what you have it in this particular case, 10,000. Then you have 15,000 liability getting knocked off, but there is no asset that you can have. So please be careful. You cannot create an asset here. In a forward contract you can do. So as far as the writer is concerned, this is the one that I was just telling. There will be a small difference between a forward contract and writing a put option that you have. So in the case of forward contract, you can derive benefit, whereas in the case of a writer of put option, you can derive benefit only in the form of taking premium. I mean, the premium that is charged at the upfront. In this problem, they have mentioned that there is no premium at all. So therefore, you will not be booking any amount of asset. So the scheme of journal entries would be one and the same. So in fact, I would be very happy to copy this and book it there. Copy and book. So in fact, I would not be just be continuing with this number. Quarter ending, loss given, loss reduced. Correct. By 30th of September for the third quarter ending, profit scenario. So in fact, in the earlier case, it resulted in a profit figure. They mentioned a profit figure of 12,000. That profit figure will not be there. Profit figure will not be there. So profit cannot be booked by a writer. Profit cannot be booked by a writer except for the premium. And in fact, there is no profit cannot be booked by a writer except for the premium. In fact, there is no premium in this case. Profit cannot be booked by a writer except for the premium. In fact, there is no premium in this case. debit derivative liability to the extent of 15,000, credit profit and loss account to the extent of 15,000. And it was a scenario of no loss, no profit. So if one knows something about derivatives, they will be in a better position to understand. That is the reason as why I was just telling you on that day, it is better that you take it up in one shot. And finally, it resulted in a loss. That will result in a loss to the extent of 40,000. 31st of December, for the quarter ending, loss is 40,000. So 20,000 into 66 minus 68. So debit those journal entries that we will be passing instead of 52,000, only 40,000 straight away we will be booking the loss. So debit bank or debit cash. So I better use cash. That is, our cash with the bank is only cash. Whenever you want, you can encash, no? So therefore, separately a bank is not required. This is my personal feeling. Debit cash 1320, credit profit and loss account 40,000, and credit the delivery provider, that is cash. This is dollar, this is rupee, 1360. So with this, I would consider that illustration number 5. There's 3 and 5 are almost the same. So as a writer of put option, he will not be booking any gain except for the premium amount. Premium amount is not there. So there is no question of booking any gain there. So therefore, instead of 52,000, we are taking up as 40,000. Okay. So now let us just take up on to illustration number 6. I do not know whether it was taken up already, but anyway, we will try. Let us not have that. I think we have just done this. I think we have just done this. Transaction cost as how that got split. So illustration number 6 we have done. So no need to duplicate. Now we have only 4 to try. Illustration number 4 to be done. Now let's just go through illustration number 4. This could be the last problem for financial instruments. Okay. So entity A, an rupee functional currency entity enters into a USD 1 million sale contract on 1st January X1 with an entity and rupee functional currency entity to sell equipment on 30th of June X1. So two entities with rupee functional currency, they want to sell the equipment on 30th of June. Spot rate on 1st of January 1 USD 45 on 31st of March 57. 3 months forward rate was 45. 6 months forward on 1st of January 55. Spot rate on 30th of June is 60. Assume that these contracts have an embedded derivative that is not closely related and requires separation. Please provide detailed journal entries in the books of A for accounting of such embedded derivative until sale is actually made. Correct. Now let us just take up. And that is how the scheme of journal entries have got to be taken up. So we have the spot rate on 1st of January. We have the spot rate on 31st of March. So 3 months forward rate on 31st of March, 6 months forward rate on 1st of January, then all that you have on 30th of June, what exactly was the spot rate? So what exactly had happened between them? A entered into 1 million USD sale contract to sell the equipment. They have entered into a contract on 1st of January. where a settlement will take place on 30th of June. So, not in books of B, we want this to be taken up. In the books of A, this same has got to be taken up. Now, let's have what sort of things that we have got to be careful with until we completely take up to 30th of June. So, it will be wonderful thing that we just learn in the classroom, and we have just given adequate amount of discussion for this. Now, let's just take up. The contract should be separated using 6 months USD forward exchange rate as on the date of the contract, which is 55. So when you are now, let us just take up the time scales. Question number 4. So this by 1st of January, 30th of June. So you are entering into your contract for sale for 1 million US dollar. 1 million US dollar. Settlement is this. Spot rate is 45. Spot rate is 45. Forward rate. So you have 3 months forward rate, you have 6 months forward rate on 31st of March. What is happening? Let us just see. Spot rate 1st January, 31st of March, 57. So we will fix 3 months forward rate on this is 45. 45. 6 months forward rate is 55. Correct. Then spot rate on that date being 60. Correct. So here you will be not having a forward rate. So 6 months forward rate is for this date and 6 months forward rate is for this. Correct. So let us basically understand as what these numbers would really mean for you. So these are the things that they have provided: spot rate on 3 different dates and spot rate for 3 different dates and 2 forward rates that they have given. So one on 1st of January, 6 months forward rate at 55, and by 31st of March, 3 months forward they have given as 45. Now let's just go through what Institute is just trying to say. The contract should be separated using 6 months forward exchange rate as at the date of the contract USD 55. So what is this 55? So 55 is the rate at which they have entered into a forward contract. That is the reason as why it will always be good to put a time scale and that read one by one. So a sale contract is for 55 million rupees. So 1 million into 55 is going to be 55 million. Yes, 6 months currency forward is taken up at 55. Correct. This gives rise to a gain or loss on the derivative and a corresponding derivative asset or liability. So on that date, this is what it had happened. On delivery, what will happen? Entity A records the sale at the amount of the host contract. So 55 million. The embedded derivative is considered to expire on that date, because since it was taken for 6 months, on that date of delivery, it will automatically get expired. So the derivative asset or liability, the cumulative gain or loss is settled by becoming part of the financial asset or liability. Remember that we have taken up 52,000 and 12,000. In this case, the carrying amount of the currency forward on 30th of June on maturity date is 1,000 into 60. Where from we are getting that 60? 60 is the spot rate on that date, correct? Minus 55 into 1 million. So the difference between the two is 5 million. So when you just multiply, let me just check up. So 10 lakhs into 60 memory plus and 55 into 10 lakhs memory minus, you end up with 50 lakhs as a difference. So on this particular date, embedded derivative, that value is going to be nil. Remember, when you are entering into a contract on this date, on 1st of January, X1, on the 1st of January, X1, date, transaction, and journal entry. A forward contract you have entered. Forward contract entered. Fair value will always be 0. So I cannot be passing a journal entry with 0 value for debit and credit. So therefore, no entry is passed. No entry is passed. Correct? That is what you find, nil value. No journal entry is passed. No entry is to be made. Next. On 31st of March, what is happening? On 31st of March, you have entered into a contract of 45. So now, for the same maturity period of 30th of June, you find forward rates are available at 45. So what you have booked at 55, now everybody else will be booking at 45. You are booking a loss to the extent of 10 per dollar. 10 per dollar for 1 million is going to be 10 million. 10 million. So which is going to be a liability, which is a loss. Correct? On 31st of March, X1, forward rate dropped from 55 to 45. So change in fair value is loss. That is rupees 10 per dollar. Rupees 10 per dollar. So the debit, profit and loss account, credit, derivative liability. So 10 into 1 million is going to be 10 million. Correct? The journal entry is this on this date. This is the journal entry that we are expected to pass. Then by 30th of June, X1. Now on that date, it went up to 60. So maturity date, spot settled at rupees 60. So change in fair value is rupees 15 per dollar. How come? 60 minus 45. So debit, derivative liability 10 million, debit, derivative asset 5 million, credit, profit and loss account 15 million. Correct? On this date, when actual delivery is taken up, debit, so this is sale transaction happening. Sale transaction. Debit trade receivable into 55. Because remember the transaction that they booked. At 55 only they booked. $55 million credit revenue. So let me just check up what is the asset that they are selling. Enters into to sell equipment. For them, selling equipment may be a basic inventory, it seems. 55 million. And there is an extra sum that we have got to receive, because you would be receiving 5 million extra. So transfer of asset to trade receivable. Debit trade receivable 5 million, credit derivative asset. $5 million. That's it. So with that, all financial instruments got over. So every illustration in the institute material we have worked. Every book back question we have worked out. This would result in a very big expectation that people will normally be having in their mind that financial instrument topic is very easy. In fact, it is correct. So do not attempt understanding these financial instruments without learning something on the derivative topic that you have in AFM. So in fact, we should have learned AFM first before taking up on to FR. So with that, financial instrument is coming to an end. Now let us just see as what other areas that we can take it up. So let me take up on to employee benefits. So we will have half an hour on to employee benefits, and the rest we can see it in the next class. Okay. So let me just consider Ind AS 19, employees cost. Employees cost can be classified into 4 categories. Short-term benefits, other long-term benefits, termination benefits, then post-employment benefits. Short-term benefits where they are payable for less than or equal to 12 months from the reporting date. It requires no present value computation. In all other cases requiring present value computations. Requiring present value computation. Requiring present value computation is there for these 3. Of them, very important is coming under post-employment benefit. That is rank number 1. Short-term benefits, rank number 2, 3 and 4. These are the orders in which you find them as very important for our examination purposes. See, under post-employment benefits, there are two different ways of carrying out the liabilities there. One is defined benefit plan. The other one is defined contribution plan. As DBP, the other one is DCP. Defined benefit plan and defined contribution plan. What do you mean by defined benefit plan and defined contribution plan? Defined benefit plan, where the employer takes the responsibility of providing all the services that he is promising for whatever may be the cost that he would be incurring. It may range, since it is post-employment benefit, it may range for a short term of 2 years to any number of years. So, until that term that he had agreed to serve or service the past employees, he is expected to carry out. Whereas in the defined contribution plan, his liability is limited to the extent of the contribution that he is expected to make. Once the contribution is over, there is no liability associated with that. In the case of defined benefit plan, the responsibility is more, where the responsibility that he has got to discharge, where he will be having something like sinking fund investments account and sinking fund account in another place. So you have two accounts, defined benefit obligation account, and to match with that, he will be putting his money on plan assets. So what will happen is that an employer, what he does is that he will be taking care of the responsibility, that is taking care of the benefits of employees, and he would always be changing his plans to the benefit of the employees depending upon the cost of living index, requirement, new regime, and new technology. So you find the dynamics of conduct of business would be changing time to time, and what was agreed upon 5 years back may not be effective, and employees will keep demanding because the industrial standards would have improved, and competitors might have just played a different sort of aspect, and the changes will automatically get adjusted, and the demands will be raised on employees are expected to discharge their duties. So this is going to be the cost that they pay. When you grow big, you should also be knowing as what responsibilities that you carry. So as you find the obligations going up, literally, laterally, in whatever form, or exponentially also in some cases. So where you find, to meet those obligations, there should always be a definite plan he should be keeping. So when the cash flows are likely to be at various stages, because employees might also be exiting, and the responsibilities of the employer will keep raising at various points of time. Say, for example, the defined benefit plan may be to provide medical facilities to past employees. So you would know that as the age is going up, naturally the cost of meeting those medical expenses will be on the higher side. So as the technology is improving, the cost will also be going up. So to meet the obligations that are expected to fall at various points of time with the help of actuaries, these actuaries will also be giving them a direction as how the obligations are to be met, and where the employer is expected to provide liquidity for meeting those plans, and that investment plan is what we'll be referring to as plan assets. So as the investments are kept exclusively for the purpose of meeting the obligation, what would happen is that the plan assets value might go up or come down depending upon the market interest rates and expectations and sentiments in the market. So at various points of time, he is expected to, there will always be a challenge for the employer to keep the plan assets exceeding the obligation. But seldom it happens because, as I told you, the dynamics are such that you find the obligations will always be growing beyond the expectation and plan assets. So there will always be some actuarial gain and the losses that would be resulting, which may not be resulting in the form of immediate cash outflow or inflow as the case may be. And therefore, such actuarial changes which are rooted through OC also we are expected to carry in our mind when we are preparing this DBO and PA. So plan assets. Now let us just take up such of those cases in our discussion, and let us just leave encashment and all that is very simple only, but we will carry out that even if time is not permitting. We will just take up that. So to start with, let us just take up on to illustration number 13. How will the following be presented in the balance sheet of Udyog Limited? Present value of defined benefit obligation 3500 and a fair value of plan assets 3332. So prima facie, it might get you or give you the impression that we are expected to report separately plan assets and separately the defined benefit obligation. So when we do that, so what would happen is that we will create an impression in the minds of any reader and to the general public that this much of assets are there, and that might cause a misunderstanding amongst the users that these assets are available for profit generation. See, the asset is kept for a limited purpose, for a specific purpose, instead of saying that it is a limited purpose for a specific purpose. How is that we can consider this as an asset of the entity, just like the money that is being placed in PPE or investment in property? So we are expected to show on a net basis. Now let's just go through that as what we do have. So defined benefit obligation, we are expected to report in the inner column at 3500. The fair value of the plan assets are expected to be deducted, and only the net amount is to be shown in the outer column of your balance sheet. Deficit to be treated as net defined benefit liability under non-current liability as provisions in the balance sheet. So all of you please just understand that even if it were to be in the negative, it will be reported only on the liability side only. Just because it is turning out to be negative, it will not be shown on the asset side. So there is always a prohibition to report this matter on the asset side. So therefore, it is to be reported on the liability side. Is that clear? So now let us just take up on to illustration number 14. How will the following information be presented? Say this particular topic is not that what should I say popular in the circuit of paper setting, but nevertheless it's not that difficult and you can go prepared for that. Okay, so now let us just take up how will the following information be presented in the balance sheet of Udyog Limited. You have PV of defined benefit obligation at 2750 and a fair value of plan assets at 2975, and you have an asset ceiling. So we need to know what is an asset ceiling. Now, whichever is greater or lower, something like that you would be getting. Now, let us just see that whichever is lower and whichever is higher, that sort of thing. So now present value of defined benefit plan is 2750. You have a liability to the extent of 2750, whereas you have an asset for 2970. Very rarely you just find that, but you can't be just telling when you have assets value greater, very rarely, and you cannot be just escaping the reporting. So here we are expected to do this. Surplus to be treated as defined benefit asset 225. Here you have an asset ceiling as per Ind AS 19 175. That means I cannot be reporting more than 175. There is an asset ceiling to the extent of 225. Asset ceiling that you have, least of the above is to be treated as net defined benefit asset under balance sheet. Is that okay? So have that in your mind. So illustration number 13 and 14 we have just taken up. Now the one that we are going to have now, illustration number 15, is something we will call it out as um, proportionate unit credit method, PUCM. So now let us just see that, and definitely it will be of great help to us. And now let us just take up on to illustration number 15. AJ Limited is engaged in the business of trading of chemicals, having a net worth of 150 crores. The company profitability is good, and hence the company has introduced various benefits for its employees to keep them motivated and to ensure that they stay with the organization. The company is an associate of RJ Limited, which is listed on Bombay Stock Exchange in India. The company initially did not have any HR function, but over the last 2 years, the management set up that function, and now HR department takes care of all the benefits related to the employees and how they can be structured in a manner beneficial to both the employees and the objectives of the company. One of the employees' benefits involve a lump sum payment to employee on termination of service, and that is equal to 1% of final salary for each year of service. Consider the salary in year number 1 as 10,000, assumed to increase at 7% compound each year. Taking a discount at the rate of 10% per annum, you are required to show the benefits attributed year to year or year on year, and the obligation in respect of this benefit year on year for an employee who is expected to leave at the end of 5 following assumptions may be taken to solve this. There are no change in actuarial assumption. No additional adjustments are needed to reflect the profitability that the employee may leave the entity at an earlier or later date. So they have just taken a technical, that is clinical study. Now let's just have a look at as how the matter is got to be solved. And we can't take up computation number 1 directly, and we are expected to do a different way of approach. So now working on number 1 is what we are expected to take up. So how the same has got to be taken up. Now let us just see. We will also be trying it out through our Excel sheet. Okay. So now all of you please just closely follow. It is not a very difficult one, very easy one only. Year number 1, 2, 3, 4 and 5. So with salary, where you have the salary moving up by so with the 10,000 there, they have mentioned it as 10,000. 10,000 in year number 1, 7% increase up 10,000. This is going to be this into 1.07, 0. So that's the way we have computed the amount of pay that they are going to draw at the end of the 5th year. So what is that they have mentioned there? 1% of the last pay drawn. So one of the employees' benefit is lump sum to employee that is equivalent to 1% of the final salary for each year of service. So benefit is 1% of the last pay drawn multiplied by number of years of service, which is going to be 1% into 13,108 into 5. One percentage into 13,108 into 5. 655.4. 655.4. Payable lump sum at Y5. So that means the last payment shall be, that means per annum is 655 divided by 5, which is going to be 655 divided by 5, 131 per annum. Correct? So that way we are expected to derive this. This is working note number 1. So now if I need to have 131, so when it is 131 here, how much it should be for on present value basis? So for that, which is 131, discount factor is 10% is what they said, divided by 1.1. So it is to be understood as 119. So 131 I got to do it in year number 5 would mean in year number 4 I got to do that less than 131. That is what you have, 119. So this way we are expected to operate in the reverse. This is given. This being 131 into 1 divided by 1.1, because it is only 1 year away. This is going to be 131 into 1 divided by 1.1 to the power 2, because it is 1 year away. It is 2 years away. And in this particular case, this would be 3 years away. And in this case, it is 4 years away. Three years away. Correct. So when you have that, this much is what you are expected to create in each one of those years. That is what they have just reported. Are you clear? And now let's just go through as how the same has got to be taken up. That means we are and let us just know about right. These are the ways through which you have got to do. So now let us just do that exercise. How much we have got to provide? Current year provision. Current year provision is this. So when I have created a liability, there is going to be interest cost that you have got to take up. Interest cost that we are expected to take up. Round. On this, we have got to apply 10%. So we have got to add, we have got to take up the closing. So closing is nothing but current plus interest. This is like this, whereas in this fashion, it is going to be plus this and this. We will be in a position to arrive at 655. Now let's just know about how we are expected to work. Now let's just know about how that numbers are arrived at. So this interest has got to be taken up. Round. So 9, in this case, it should be changed. Let's know about that 89, 9, 98, 196. So it is better that I just write it out separately. Current year provision, interest, then closing. Interest is not there for the first year. That's a mistake I committed. 89 plus 0. So interest is to be computed on this number into 0.10, 0. Now it is going to be 89 plus 98 plus 9. Right. Now that 655, you are in a position to derive in this fashion. So how much you take for the current obligation, how much is the interest. So this is the way we are taking it up. So let me just put this one as 49. Then it will become 655. The rounding off error will always be there. So computation of benefit, how much you should consider in each one of those years as employees cost. See, now let us just pass journal entry by year number 1. So debit profit and loss account, how much? 89. Credit employees defined benefit obligation. How much is that? 89. Right. In year number 2, debit interest. How much is the interest? 9. Credit DBO 9. Then debit P&L account, credit DBO. How much is the figure that we got to take up? It is going to be 98. Right. In year number 3, now let us just see. Interest is going to be 20. This amount is going to be 108. Year number 4, interest will be 32. And our profit and loss account figure is going to be 119. Year number 5, interest will be 49. Profit and loss account 131. So thus in your profit and loss account, interest expenditure and these will automatically be taken up. So now debit P&L, 9 and credit interest. Okay. So these are the ways through which we are expected to close it, and we will try out with some other full-fledged figure in the next class, concluding class tomorrow when we meet. Okay. Thank you.